So Garrett, can you talk about what, oh, shit.
Okay.
Oh. Hi guys, welcome back. I'm here with my friend Garret Cerkvenik of Lendplicity Mortgage, and we're gonna answer some lending questions today.
Great, thanks Jocelyn.
So Garrett, can you please describe the difference between a fixed rate mortgage and an adjustable rate mortgage?
Sure. So fixed is pretty self-explanatory. Obviously, it's a fixed payment that's never going to change over the life of the loan.
Okay.
With an adjustable, you typically have a short fixed period. Could be anywhere from 1, 3, 5, even up to 10 years. So your rate payment stays the same, and then after that period, it's going to adjust with the market.
Okay. How does that rate? I guess, how do we determine what that rate is going to be after that fixed period?
Great question. So you typically have what's called an index and a margin. So your index could be anything from, for instance, a lot of them are based on the LIBOR, which is the London Interbank Offered Rate.
Okay.
So you have that amount that sets a base amount, and then you have a margin on top of that. So let's say the LIBOR is at 3% and your margin is 2%, your interest rate would jump to a 5%.
Okay.
So it really depends on those, two factors as far as what your rate's going to be after the fixed period.
Cool. So Garrett, at what point would someone choose to go with a fixed rate versus an adjustable rate mortgage?
So it really depends on your long-term goals. If you're somebody that's going to stay in this house forever, never wants to refinance, a fixed product might be the best option for you.
Okay.
If you're somebody that tells me, this is a 5-year house, this is a starter home, I'm only going to be here for 5 years and then we're going to sell. There's no sense in paying the extra interest on a 30-year fixed when you really only need that rate to be locked in for 5 years.
Got it.
You could do a 7 or a 10 at that point and have a little bit of a buffer just in case you stay longer, but still get a better interest rate that you would see with an ARM. So
Garrett, at the start of COVID, we started hearing this word forbearance a lot and the potential for foreclosures. Can you touch on that a little bit?
Yeah. When COVID hit, a lot of people were struggling. People were losing their job, people were having to stay home. And so mortgage companies really did a great job at trying to keep people in their loans and in their homes. And they offered a lot of forbearance programs that would allow people to basically defer payments. Most common one was they would allow them to defer for 3 months. The challenge was that after that 3 months, a lot of people had to make all 4 payments at once.
Right.
So there was a big concern that was going to lead to a ton of foreclosures and people losing their homes, which really didn't happen. Banks did a great job of being able to extend those programs, spread out the amount that was owed over a long period of time, or even tack those payments on the back of their mortgage. And for the people that still were in trouble after that period of time, right now home values are at an all-time high. So instead of going through the process of foreclosing and losing your home and losing it all,
you could just sell it.
Why don't you just sell? You've
Right.
got a big pile of cash sitting there. So foreclosure rates are at an all-time low.
Cool. All right, so that's it for today. Thank you so much, Garrett, for your time. Appreciate you being here.
Thanks for having me.
And tune in for next week's video when we talk about how self-employment impacts qualifying for a home loan.